CCs don't have positive gamma. Bad in a good way? I mean, no. Unless you live in a country with like no running water and you harvest your own food. I've traded at least 2 crashes. This isn't the first build up into what I've seen. It's okay. I'm long wheat. Ding ding. Well, we've survived another day. Ring ring, Marge is calling. We'll see. It's got to be getting close. Yeah, Montgomery. Did I miss anything exciting in Power Hour? There was a nice 100 BPS drop into close. I don't know. OG rules. We'll see. What VIX calls do you buy for a hedge? I buy in the money, generally like 0.8, 0.7 delta. Margin calling, market exposed to the downside. If what we think is going to happen happens, first short positions in the market will be squeezed out. Then we would get, hold on. So first, like, short positions would get squeezed out, and then we would crash. The same thing happened here. I'll show you guys. So if you go back here to Feb, 2018, this is Volmageddon. And this had to do with the exploding of over-leveraged, VIX products. But, basically, you know, long positions started getting, or long volatility positions started getting squeezed out of the market. And then once they were out, mass sell-off, right? Risk tails collapse. So if you look at the VIX during this period, uh, was it? So yeah, if you look at VIX during this period, VIX starts moving up really hard. Right, and then, you know, this asymmetric risk or these tails collapse and VIX squeezed. This is about the point at which they tried to stop it, which was roughly beginning of January 2018. Then about exactly 30 days later, it crashed. It happened really, really fast. And asymmetric risk in the market right now is really wide, right? So if these tails collapse, and you can tell around November, they start losing control of their ability to maintain short volatility positions, right? But at the same time, you know, because the market hasn't crashed, shorts are losing their ability to stay long volatility. It can happen really rapidly. But yeah, we'll see what happens. I mean, the market's definitely already behaving very, very strangely, right? Well, by mispricing risk in the market, you create asymmetry in the risk profile that everyone in the market is hedging against, right? And then you know the more you short volatility, the more asymmetry you create. Eventually, those asymmetric tails will destabilize, and when they do, they collapse. I think we're already starting to see destabilization in market-wide asymmetric risk. No, we could still have the short-term up part, right? Because the first thing that'll happen is when primes notice the risk, and you'll see this in all crashes, right? If you go back through here, I'll show you guys. If you go back through, you know, historical crashes, you'll see these periods of surge, hard upward surge before an actual crash. You know, everyone likes to point out, you know, the bear rallies and the crash. We're not really at that part yet. You'll see these hard upward surges into the crash, right? And that's because their economic forecasting is far better than ours, right? This is '08, right? You know, we move up really hard. And '08, a lot of institutions didn't see coming, but some did, right? And they got the fuck out. And you know, when primes de-risk the market, most margin is lent to the short side. So that means that they margin call shorts. And then shorts have to start buying, which drives prices up, which is perfect for the longs, right? Because then they can sell at the top. I mean, if there was ever an opportunity for MOASS to happen, an event like this would be where it would. I do suspect that GME doesn't have that many entrenched shorts, but it's got enough. Things could get squeezy. Jan 2021 was a similar effect, just in reverse, right? The market just kept rising against the shorts. But now, instead of the market rising against them, which it is a little bit, and they're way more leveraged now, the market is instead drying up around them, right? So instead of the market moving up and pressuring their positions, the liquidity is drying up around them, so they're unable to stabilize their positions. I explained this the other day with ETFs, and I do still think they're a contagion in all of this. You know, ETF liquidity, you have to think of it like a reactor, right? And cash liquidity is the coolant. So if they stop cycling cash through ETFs, the ETFs melt down because most of them are so unbelievably over short. I mean, like the SPY is like 50% short. XRT's in the hundreds of percents, right? Like the massive short positions tied up, and they constantly need to be rotating around those T plus like 635 C plus 3 cycles, right? Clearing out those old obligations and replacing them with new ones. So yeah, I mean, no one knows what's going to happen in an event like this if it happens, because it's destabilizing, right? You know, the orderly function of the markets goes out the window. But OPEX is coming up, and we know big shit likes to happen around OPEX. So we'll find out real soon. Anyway, thank you guys. I'll see you tomorrow, and have a great night.